Hello everyone. When people think about investing, stocks often come to mind first. But there is another major type of investment that plays an important role in building wealth and managing risk. This investment is called a bond. Bonds are commonly described as safer or more stable than stocks, but many beginner investors don't fully understand what a bond actually is or how it works. In this video, we're going to clearly explain what a bond is, why investors use bonds, how bonds generate returns, and what role they play in long-term investing. By the end of this video, you'll have a clear understanding of bonds and how they fit into a complete investment strategy. So what is a bond? A bond is a type of investment where an investor lends money to a borrower in exchange for regular interest payments and the return of the original amount at a future date. The borrower can be a government, a corporation, or another organization that needs funding. When you buy a bond, you are essentially becoming a lender rather than an owner. So why do governments and companies issue bonds? Borrowers issue bonds to raise money for various purposes. Governments use bonds to fund public projects, manage budgets, and support economic activity. Companies issue bonds to expand operations, invest in new projects, or refinance existing debt. Bonds provide a way to raise large amounts of capital without giving up ownership. So how do bonds make money for investors? Bonds typically generate income through regular interest payments, known as coupons. These payments are made at scheduled intervals, such as monthly, quarterly, or annually. At the end of the bond's term, the borrower repays the original investment amount, known as the principal. The combination of interest payments and principal repayment forms the investor's return. So how is a bond different from a stock? The key difference between bonds and stocks is the relationship to the company or government. When you own a stock, you own a portion of a company. When you own a bond, you are lending money. Stock returns depend on company growth and market prices. Bond returns depend mainly on interest payments and repayment of principal. Bonds generally offer more predictable income, while stocks offer greater growth potential. So what is a maturity of a bond? The maturity of a bond refers to the length of time until the borrower repays the principal. Some bonds mature in a few months, while others may take decades. Short-term bonds usually have lower interest rates. Long-term bonds often offer higher rates to compensate for longer commitment. Maturity affects both income and risk. So why are bonds often considered more stable than stocks? Bonds are often viewed as more stable because they provide regular income and have a defined repayment date. As long as the borrower makes payments as promised, bondholders receive predictable returns. However, stability does not mean zero risk. Borrowers can face financial trouble, and bond prices can fluctuate. Bonds tend to experience less dramatic swings than stocks. So what types of bonds exist? There are several common types of bonds, some of which include government bonds, corporate bonds, municipal bonds, treasury bonds and notes. Each type has different levels of risk, income potential, and tax considerations. Understanding the differences helps investors choose bonds that fit their goals. So how does interest rate change affect bonds? Bond prices move in response to interest rate changes. When interest rates rise, existing bond prices tend to fall. When interest rates fall, existing bond prices tend to rise. This happens because new bonds are issued with different interest rates, making older bonds more or less attractive. Interest rate risk is one of the main factors affecting bond values. So can bonds lose value? Yes, bonds can lose value. Bond prices can decline if interest rates rise or if the borrower's financial condition worsens. However, if a bond is held to maturity and the borrower does not default, the investor usually receives the full principal back. Short-term price fluctuations matter more for investors who sell before maturity. So why do investors include bonds in their portfolios? Investors use bonds to generate steady income, reduce overall portfolio volatility, preserve capital, and balance risk. Bonds often behave differently than stocks, which can help smooth performance over time. So how do bonds affect portfolio risk? Because bonds tend to be less volatile than stocks, adding bonds can reduce large swings in portfolio value. They act as a stabilizing force during periods of market uncertainty. This doesn't eliminate risk, but it helps manage it more effectively. So are bonds always safe investments? No investment is completely risk-free, and bonds are no exception. Some risks include borrower default, interest rate changes, and inflation reducing purchasing power. Some bonds are safer than others depending on who issues them. Understanding risk is essential when investing in bonds. So how do credit ratings relate to bonds? Credit ratings measure a borrower's ability to repay debt. Higher-rated bonds are considered safer but usually offer lower interest rates. Lower-rated bonds offer higher income potential but carry greater risk. Credit ratings help investors assess bond quality. So how does inflation impact bond returns? Inflation reduces the purchasing power of fixed interest payments. If inflation rises faster than bond income, real returns can decrease. This is why investors consider inflation when choosing bonds and building portfolios. So how long should investors hold bonds? The length of time bonds are held depends on investment goals and income needs. Some investors hold bonds to maturity for steady income. Others trade bonds to take advantage of price changes. Time horizon plays a key role in bond strategy. So why do bonds play a role in long-term wealth building? While bonds may not grow as rapidly as stocks, they provide stability and income. They help protect portfolios during downturns and provide resources for future opportunities. Bonds support steady progress alongside growth investments. So how do bonds fit into a balanced investment strategy? Balanced strategies often include both growth-oriented assets and income-focused assets. Bonds help offset the volatility of riskier investments. This balance allows investors to pursue growth while managing uncertainty. So how should beginner investors think about bonds? Beginner investors should view bonds as tools for stability and income. They are not meant to replace growth investments but to complement them. Understanding bonds helps investors build diversified and resilient portfolios. A bond is a loan made by an investor to a government or company in exchange for regular interest payments and the return of the original investment. A bond allows you to own a portion of a company without having to carry the responsibilities of owning the company. They provide a more straightforward approach to investing and is relatively less complicated than investing in stocks considering the fixed interest rate and fixed maturity date of the bond. Bonds provide steady income, stability, and balance within an investment strategy. While they carry risks, they play an important role in managing volatility and supporting long-term wealth building, and still considered to have lower risks than investing in stocks. By understanding how bonds work, investors gain another powerful tool for building a thoughtful and resilient financial future. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and check out our channel for more amazing videos that can help you grow your investment portfolio.